You've been told it your whole life, by the media, by financial gurus, maybe even your own parents. But what if I told you that one of the biggest rules of investing is actually a lie? A lie that's quietly draining your potential wealth and holding you back from true financial freedom. Today, we're exposing the biggest investing myth you still believe and showing you what to do instead. Get ready to challenge everything you think you know about building wealth. Today, we will talk about the biggest investing lie you still believe. So before we start, make sure to hit the like button and subscribe to my channel. 1. Timing the market is the key to wealth. One of the most persistent lies in investing is the belief that you can successfully and consistently time the market, buy low and sell high, without fail. This seductive idea suggests that if you just watch the trends closely enough or listen to the right guru, you'll be able to exit before crashes and re-enter before booms. But history tells another story. Professional fund managers, equipped with teams of analysts and data, often underperform the market precisely because of attempts to time it. Studies from institutions like Morningstar and DALBAR show that investor returns consistently lag behind fund returns due to poorly timed buying and selling. Emotions, not logic, often drive these decisions. Greed makes us chase rallies. Fear makes us exit during crashes. This undermines long-term compounding. The truth? Timing the market beats timing the market. Staying invested, even during downturns, has proven more profitable than trying to dodge volatility. 2. You need to be rich to start investing. Another common misconception is that investing is only for the wealthy. This lie has kept millions on the sidelines, assuming they need thousands of dollars to begin. The truth is that you can start investing with as little as $1 today, thanks to fractional shares, zero-commission trading apps, and robo-advisors. In fact, starting early with small amounts often beats starting late with big money due to the power of compound interest. For instance, investing just $50 a month from age 25 to 65 in an S&P 500 index fund, averaging 8% annually, could leave you with nearly $175,000. Contrast that with someone who starts at 40 and invests $200 a month. They may end up with less despite investing more monthly. Accessibility is no longer a barrier. It's not how much you start with, but how consistently and how long you invest. Early habits matter more than early wealth. 3. Higher risk always equals higher reward. The idea that more risk guarantees more reward is oversimplified and often dangerous. While it's true that certain risky investments offer the potential for higher returns, not all risk is compensated. This lie stems from a misunderstanding of the risk-return trade-off. High volatility does not always translate to high returns. Just ask those who held onto meme stocks or speculative crypto assets. Many high-risk assets crash and never recover. True investing wisdom lies in taking calculated risks, ones that have historically yielded better outcomes, like diversified equity portfolios. Risk should be measured, not blindly pursued. Smart investors assess downside risk, asset correlation, and long-term trends, rather than chasing lottery ticket opportunities. Also, risk tolerance changes over time. What's appropriate at 25 may not suit someone at 60. The goal isn't to eliminate risk, but to manage it wisely. Risk and reward are related, but not in a linear, predictable fashion. 4. You need to pick winning stocks. Thanks to the media's obsession with stock-picking heroes like Warren Buffett, many people still believe investing success lies in finding the next Amazon early. This leads individuals to pour hours into analyzing individual companies, chasing speculative tips, or blindly following social media influencers. The truth is, most stock pickers, professional or amateur, fail to beat the market over time. SPIVA reports show that more than 80% of actively managed funds underperform their benchmarks over a 10-year period. Why? Because markets are largely efficient. Prices often reflect available information instantly. Moreover, even great companies may not be great investments if bought at the wrong price. Passive investing through low-cost index funds offers broad diversification, lower fees, and long-term performance that consistently outpaces most active strategies. You don't need to pick winners, you just need to own the market. And with that ownership, you'll ride the wave of global economic growth. 5. The market is too risky right now. Every year, headlines scream about why now is the worst time to invest. Wars, elections, inflation, debt ceilings, pandemics. And yet, over any long-term horizon, the market has always climbed higher. This investing lie, that the market is uniquely dangerous right now, feeds on fear. It convinces people to hoard cash or wait for a better time, which often never comes. The S&P 500 has endured world wars, recessions, 9/11 events, housing collapses, tech bubbles, and COVID-19. Despite all this, it has averaged about 8 to 10% annual returns over the last century. Timing your entry based on perceived macro risk is rarely successful. In fact, some of the best market days occur within the worst weeks. Missing just the top 10 performing days over 20 years can have your returns. The market is always risky in the short term, but long-term investing rewards patience. Risk is the price you pay for growth. 6. More information equals better decisions. In the digital age, it's easy to believe that more news, data, and analysis leads to better investing decisions. However, this is often a dangerous delusion. The problem isn't access to information, it's information overload. Humans aren't wired to process vast quantities of conflicting data, and the more news we consume, the more likely we are to act impulsively. Every article, tweet, or TV segment seems urgent, creating false pressure to do something. But investing success isn't about reacting quickly, it's about staying the course. Legendary investors like Jack Bogle and Charlie Munger preach simplicity and discipline, not frantic data analysis. 7. Past performance predicts future results. It's a comforting belief. If a fund or a stock has done well in the past, it's bound to continue. But that's another major investing lie. Every disclaimer says it. Past performance is not indicative of future results. And for good reason. Markets evolve, leadership rotates, and yesterday's winners often become tomorrow's losers. Take mutual fund rankings. Many top performers one year end up in the bottom quartile the next. Even entire asset classes rotate in and out of favor. Chasing past returns often leads investors to buy high and sell low, locking in poor outcomes. The better approach is to focus on process over performance, choosing diversified, low-cost investments with strong fundamentals and a long-term horizon. 8. Real estate is always safer than stocks. The belief that real estate is a safer or better investment than stocks is deeply ingrained, especially in cultures where home ownership is prized. But this perception overlooks key risks. Real estate is illiquid, expensive to maintain, and highly localized. It can be a great asset class, but it's far from risk-free. Housing bubbles burst. Just ask anyone who lived through 2008. Moreover, real estate requires significant leverage, tying your fortunes to interest rates, local economies, and tenant reliability. Stocks, by contrast, offer liquidity, instant diversification, and global exposure. Over long time periods, the stock market has outperformed real estate in total returns, especially when reinvested dividends are included. That said, both asset classes have a place in a balanced portfolio. But the idea that one is inherently safer than the other is misleading. Safety comes from diversification, not from buying what feels familiar or tangible. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.